If you look for financial strategies online, you will likely encounter pitches for infinite banking or 7702 planning. These presentations usually emphasize two specific features: tax-free growth and the ability to borrow against your own assets. The marketing focuses on the promise of rapid, effortless wealth accumulation without the volatility of the stock market. This is not a new type of bank account. The underlying instrument is a whole life insurance contract that has been engineered to prioritize cash over the death benefit. Comparing viral marketing to actual policy mechanics shows why results depend entirely on how the contract is built and managed. A permanent life insurance policy is divided into two parts: the death benefit paid to beneficiaries and the cash value you can access during your lifetime. Standard whole life designs use early premiums to fund the death benefit and agent commissions. This is why a typical policy has very little liquid cash in the first few years. This chart shows how premium allocation changes the policy. By minimizing the death benefit, more of each dollar is directed toward the cash value bucket. Allocating premiums this way allows the cash value to grow into an accessible capital base. To accelerate that cash bucket, advisors use a specific rider called paid-up additions, or PUAs. When 60 to 80% of the premium goes into PUAs, the policy becomes efficient much faster. These additions are fully paid-up chunks of insurance that earn dividends immediately. However, the IRS maintains a limit on how much cash can be stuffed into a policy. These rules prevent people from using insurance as a pure tax shelter without enough actual insurance coverage. If the funding exceeds this limit, the policy is reclassified as a modified endowment contract, or a MEC. MEC status changes the tax treatment. You lose the ability to take tax-free loans, and the IRS applies a 10% penalty to any early gains you withdraw. This graph shows the line you have to walk. Effective design pushes the cash value as high as possible while staying just under the IRS limit to keep your loans tax-free. Even with an efficient design, there are internal costs. The insurance company must cover mortality charges and policy expenses up front. Because of these fees, your first-year cash value is typically 75 to 85% of what you paid in. You start with less than you contributed. This graph compares premiums paid to available cash. Early on, cash value is catching up. The break-even point occurs in year 4 or 5, when cash equals premiums paid. Past that point, compounding begins. Every new dollar adds more than a dollar to liquid cash. If you need access to your full principal in the first 24 months, you will take a loss. This is a strategy built for a 10-year time horizon or longer. The real utility of this cash is putting it to work. You use the policy as a base to fund other investments. Instead of withdrawing the money, you take a policy loan. The insurance company lends you their capital and uses your cash value as collateral. Since your money remains in the policy, it continues to earn dividends and interest on the full balance, even while you have an outstanding loan. This creates two paths for growth. Your money compounds inside the policy, while the borrowed funds earn a separate return in an outside investment. This is the mechanic of ROI stacking. The insurance company charges interest on that loan. To move forward, your outside investment must yield a higher return than the interest you are paying the carrier. Using loans for depreciating assets reduces your wealth, but borrowing to fund assets that produce cash flow can use the spread between the loan and the return to build it. Marketing often promises guaranteed positive arbitrage, suggesting you will always make a profit on policy loans regardless of the economy. This usually refers to non-direct recognition policies, where the dividend rate doesn't change when you take a loan. This spread is easy to show when interest rates are low, but if interest rates rise, insurance companies increase their variable loan rates. If the loan rate rises above the dividend rate, that projected profit disappears. Both recognition types adjust to economic conditions. Policy design and borrowing behavior determine your results more than the specific way a carrier recognizes a loan. Because this is a specific tool, it only adds value when it matches your income and financial behavior. One profile that fits is the high earner. These are professionals already maxing out their 401ks and facing high tax brackets. A 7072 plan provides a tax-free bucket for their savings without the income limits that restrict Roth IRA contributions. Another fit is the capital deployer, business owners or real estate investors who need access to cash to fund new opportunities. By utilizing the tax shelter and the movement of capital, these individuals use the growth of the policy to move past the internal expenses. The strategy is less effective for the passive saver. This is someone early in their career with a short time horizon or inactive capital. If you use a high-cost insurance contract as a basic savings account, the early lack of liquidity creates a drag on your net worth. The internal fees make it more expensive and less liquid than a standard high-yield savings account in the first few years. Without the cash flow to support it, you can find yourself locked into a structure that is too heavy for your current financial situation. High cash value life insurance can amplify existing financial momentum. It is a tool for managing capital, not a substitute for building it.